All right, welcome. Today, we are going to tackle something super important in the financial world, agreements about the future. And more specifically, we're going to look at the really clever safety net the market built to make sure those agreements don't fall apart. Let's get right into it. So think about it, just in your own life. You make a promise, someone makes a promise to you, there's always that tiny bit of doubt, right? Will they actually follow through? Well, that simple question of trust, it's not just a personal thing. It is a massive problem right at the very heart of global finance. And that really leads us perfectly into our first point, the hidden danger inside every financial promise. This is what the pros call counterparty risk. It's a fancy term, but the idea is simple. Let's say two people agree on a deal today that won't actually happen for another 6 months. I mean, anything could happen in that time, right? One of them could go out of business, or maybe they just decide, nah, I don't want to do this anymore. And that one person backing out can create a huge domino effect. So how on earth did the market solve this? Well, it came up with a truly brilliant solution, which brings us to Section 2, the market safety net. Say hello to the exchange-traded derivative, or just ETD for short. Now, the whole solution is kind of packed right there in the name. See, an ETD isn't some casual handshake deal. It's standardized, so everyone's on the same page. It's traded on a regulated exchange, not some shady backroom. And here's the killer feature. It's guaranteed. But how is that even possible? How can you guarantee a deal between two strangers? To really get why this is such a big deal, you have to look at the alternative. For a long time, deals were done over the counter, or OTC. You can think of OTC deals like custom private agreements. They're complex, it's not clear who's promising what, and they carry all of that risk that the other person might just walk away. ETDs are the complete opposite. They're out in the open, they're standardized, and they are safe. Okay, so here's the magic trick. This is how it works. A buyer and a seller agree to a trade. The moment they do, the exchange, through something called a clearinghouse, jumps right into the middle. It basically splits the deal in half. So now the seller isn't selling to the original buyer anymore, they're selling to the exchange. And the buyer isn't buying from the original seller, they're buying from the exchange. The two people who made the deal, they don't even have to trust each other anymore. They just have to trust the exchange, which is designed to be rock solid. That risk of someone backing out, poof, it's gone. So now that we see how the safety net works, let's look at the actual tools people use on it. And we're going to start with the first big one, futures contracts. A futures contract is pretty much what it sounds like. It's a contract for something in the future. But there is one word here that is absolutely critical, and that word is obligation. When you get into a futures contract, you are legally bound to follow through. It is not an option, it's a requirement. You have to buy or sell at that price on that date. And a simple analogy shows you why this is so powerful. Imagine a baker who knows she's going to need tons of wheat in 6 months, and a farmer who knows he's going to have tons of wheat to sell. Well, they can use a futures contract to agree on a price today. The baker locks in her costs, the farmer locks in his profits, and they both get to sleep at night, not worrying about whether the price of wheat is going to go crazy. They've hedged their risk. And it is so much more than just wheat. The world of futures is kind of mind-blowing. I mean, sure, you've got coffee and gold and oil, but you can also trade futures on huge stock indexes like the S&P 500, or on currencies, or interest rates, or even on something as abstract as market volatility. You can even trade futures on, get this, the weather. No joke. Okay, let's move on to the second major tool. This one builds on that same idea of a future agreement, but it has one game-changing twist. This is the world of options contracts. And this phrase right here is everything. This is the key. An option gives you the right, but not the obligation. Let that sink in. Unlike a futures contract where you have to do it, an option is a choice. You get to decide later if you want to go through with the deal, and that flexibility is incredibly powerful. And is that flexibility popular? Oh yeah. To give you an idea of the scale we're talking about, the main clearinghouse for options handled nearly 830 million contracts in a single month. That was back in February 2021. This isn't some small niche corner of the market. This is an absolute behemoth. And it's not just massive, it is growing at a wild pace. You know that 830 million number I just mentioned? Well, that was a 47.4% jump from the year before. The use of these tools is just exploding. And just like with futures, the variety here is huge. You can trade options on individual stocks, think Apple or Tesla, or on the entire market through an index. You can trade them on ETFs, on currencies, on interest rates, you name it. It is a super versatile tool. So, we've talked about the problem of trust, the exchange safety net, and the two big tools, futures and options. But let's zoom out. Let's bring it all home and ask, why does any of this matter to you? Look, it really all boils down to this one simple distinction. If you remember one single thing from all of this, let it be this. Futures are an obligation. It's a deal you must do. Options are a choice. It's a deal you can do. That one little difference changes absolutely everything. And what this all means for the average person, the retail investor, is actually fantastic. The growth of these exchange-traded products takes these complicated, risky, private deals and pulls them out into the light, into a system that's standardized, transparent, and guaranteed. It creates a market that's safer, easier to access, and has way more buyers and sellers for everyone. Which leaves us with one final thought to chew on. This whole system was designed brilliantly to get rid of the old risks, the risk of one person failing on a promise. But now, as hundreds of millions of these contracts are flying around every single month, and everything is so interconnected, what new risks might be hiding in plain sight? Something to think about. Thanks so much for joining me.